What's the difference between a mutual fund and an ETF? Well, there's a lot of terms in finance, so I'm going to try to break this down in a way that's easy to understand. I'm going to show you how they're similar, how they're different, how index funds fit into the equation, and by the end of the video, you'll know how to invest in them. Let's break it down. Mutual funds and ETFs are very similar because they allow you to buy compilations of tons of different investments all in one account. And instead of having to buy tons of different stocks all at one time, you can buy a mutual fund or an ETF where you can own partial shares of tons of different companies, and it lowers that barrier of entry. So now you can start investing and getting tons of companies to work to make you richer rather than you having to get a ton of money to try to buy all these different stocks on your own. So instead of buying one share of Apple or Google, you could instead buy something like the S&P 500, where now you have 500 different companies under your belt, which dramatically lowers your risk because if one company goes under, it's not really going to affect you all that much. And all those different companies over the long run have a lot longer of a trajectory of being able to go up in value and therefore stacking the odds in your favor. Let's look at the differences between ETFs and mutual funds. ETFs trade real time throughout the day, just like a stock price. And if you look up an ETF, you'll see it trading consistently throughout the day. They also tend to be a lot lower cost of entry, so you can sometimes buy them for as low as $1. And for $1 now, you can own partial shares of, again, hundreds, if not thousands of different companies. ETFs are generally more tax efficient than mutual funds as well, so while there are some taxable events that can happen in an ETF, it's not going to be as much as you would get in a mutual fund. ETFs also have active or passively managed funds. If it's actively managed, that means there's somebody that's working for that company that's trying to beat the market and they're trying to do better than that, but it also causes it to have a higher cost. So then they take a little profit off of the top, and it's highly debated whether or not this statistically is going to be worth it. In general, 85% of fund managers who are actively managing their funds tend to underperform the S&P 500, which is a passively managed fund. Passively managed funds just try to follow the stock market, and they aren't trying to beat it, but they're just trying to participate in the stock market. Mutual funds are different than ETFs because they trade at the very end of the day, so you'll see one stock price per day rather than seeing it trade throughout the day. Mutual funds are also a little more expensive to get into, so they tend to cost somewhere between $1,000 and sometimes $50,000 to start investing in them. Mutual funds are also generally less tax efficient than an ETF, and while they do have more taxable events and you might get a little bit more in taxes, it's not that different unless you have a large dollar amount. If you're investing somewhere between, let's say, $1,000 and $10,000, the difference in taxes is not going to be that dramatic. But the larger value you have that you're investing, that means those taxable events can be larger numbers and then start to matter more. But the absolute biggest predictor of your financial success is not whether or not you have an ETF or a mutual fund. It's far more about your savings rate, and that is the number one predictor of financial success. So I don't want you to be stuck just between these two, just purely off of tax questions and what's better. It's far more important just the amount that you save, more so than whether or not you choose an ETF or a mutual fund to invest in. It's also important to note that mutual funds can also be actively or passively managed as well. Speaking of passively managed, there's a type of mutual fund called an index fund. This is a passively managed type of account that's not trying to beat the market, but it's just trying to follow it. This means that it has lower costs than an actively managed fund, because in an actively managed fund, somebody has to work to try to beat the market, and that means you're paying them, their team, their salary, and that's cutting into some of the returns that they're making. But an index fund is trying to follow the market, and it's really low cost, and they charge incredibly low prices for you to be able to participate in them. So how do you actually invest in a mutual fund or an ETF? Well, there's a few different ways. First, you can invest in your retirement accounts. For example, most of your 401k, if not all of your 401k investments, are mutual funds. The IRS generally doesn't love the idea of you day trading your retirement, so they don't let you do ETFs, but they do let you do mutual funds, which trade at the very end of the day. Roth IRAs have a little more flexibility, where you can buy mutual funds and ETFs. You can also buy mutual funds and ETFs in non-retirement accounts. For example, you could invest in brokerage accounts, which are non-retirement, so you can pull them out early. You still have taxes that can occur in them, and you can watch my other videos to learn more about brokerage accounts if you like, but you can buy both mutual funds and ETFs in brokerage accounts. You can also buy them in college savings accounts called 529s. It's only mutual funds though, because the IRS also does not love you day trading your kids' college tuition. If you want a few examples, here's a mutual fund from Vanguard called VT Sachs, which buys the entire stock market and lets you participate in it. It's one of those passively managed funds. And again, because this is a mutual fund, you see that it's not day trading throughout the day, and then you only see one price update every single day. Another example is VOO. That's an ETF that's offered by Vanguard that buys the S&P 500. Again, the S&P 500 is a compilation of 500 of the largest companies in the US. And you can see the price is updating consistently, and it looks a lot more like a stock price because it's trading throughout the day, whereas the mutual fund only updated once per day. If you want to learn more about brokerage accounts or Roth IRAs, click on these videos here. Thanks for watching and follow for more finance tips.